Hello, Aaron Ninness here, Denver, Colorado, your mortgage professional. Another episode of How Much Can I Afford? Today's episode is focusing on derogatory credit. If you've ever applied for a loan and someone said, you have some negative items on your credit, or if just from maybe a collector calling you, or you missed a payment, you have negative credit items showing on your report, this episode's for you. When we talk about credit score, the range in the mortgage world is really, it goes all the way down to 350. I've never seen anything that low, but that's technically the bottom, with the top being 850. For purposes of lending, we want to see a score of 580 or higher. Now, there's certain cases where going below 580 are okay, but really 580 is the main threshold that most lenders use. From 580 to 620, that is really a zone where government loans are the most prolific, meaning a VA loan or FHA if you weren't a veteran. They do have allowances for people in that credit score range to get home financing. What you typically won't find in that credit score range is down payment assistance. Most down payment assistance, and certainly here in Colorado, start at 620 and 640 credit scores. So if you are below those and you want some assistance, a little bit of credit repair would be necessary. Now, why is your score low? There's really two columns: derogatory items or you're using too much credit. That's the most typical thing that we see. Side note, this is being filmed August 2017. At this time, a change just went into effect on credit where they no longer are reporting judgments, civil judgments, or tax liens on the credit report. And as such, if that was something on your credit report that was holding your score down, you might have a pleasant bump in that score. In fact, if you were subscribing to a free credit service and you saw recently in the month of July a big jump, that's why you saw it. July 1st is when that went into effect. Okay, so let's say you do have some lates. Category-wise, there's minor and major categories. Major would be things like a repossession, missing a housing, a mortgage payment, or a lease payment if it's reported on your credit report, or 90-day lates. When you let a payment go so far derogatory, it starts to become a major item. What is a minor? 30-day lates, or maybe a minor item like a medical collection, or just a little Comcast collection, utility collection, something like that. Those are all collections that are going to be reported on your credit report, and as such, bring your score down. If you have things like that, it's typically just a waiting period from when the last event occurred for your score to start going up. The other side of the equation is new credit or using too much credit. Every time you open a new credit card or get an inquiry, it hurts your credit score. And here's why. The algorithm is designed to provide a score based on the stability or historical proof of someone making good credit decisions. Okay, so think about that. If you opened a brand new credit card today, do we have any history that that was paid correctly? No. So the score is automatically going to assume it's not going to be paid correctly. You're actually guilty till proven innocent in this scenario. After you've made 12 payments, it now recognizes what your payment history is and will start to increase that score accordingly. Same thing goes into what percent your score or what percent of your credit you're using. 30% of your score is based on that ratio. Let's say, for example, you had a $1,000 credit card with $900 charged on it, and I had a $100,000 credit card with $90,000 on it. I think it's all fair to say that I'm in more trouble with $90,000 in credit card debt. But the reality is, you would be using 90% of your card, I would be using 90% of mine. And because we have the same percentage of usage, it is totally plausible that the score is going to carry us at the same risk threshold. So a lot of times what we see is someone goes to a retail store and they want to buy, let's say, a new TV. And they get to the front and they say, do you want a 0% interest credit card for this new TV? And the person says yes. So they apply, they get the card, and the TV costs $1,000, right? And so they give you $1,000 on that card. Well, when you walk out of that store, not only do you have a brand new credit card with no history of payments, but you've also maxed out that credit card. Usually as you pay down credit cards down to 90%, 70, 50, 30, you start to see your score go up because the more available credit you have, the better steward you are of using credit. So a lot of times we'll see someone who has a score that's low and no derogatory credit, not at all. but they have maybe 2 credit cards, little ones, $300 limit that are almost maxed out. And because of that, their score is being held low. We can pay those down to maybe $10, get a rescore done on your credit report, very simple process, and get a new score to help you get qualified. So the reality is that there's a lot that goes into derogatory credit. When you start the home buying process, very important to get pre-qualified. Talk to a mortgage professional, someone like myself, and make sure that they've analyzed your credit to figure out, 1, do you qualify? And 2, are there things that we can do to get you into a better position to be a successful homeowner? As you go through this series, you're going to hear lots of different terms getting thrown around and lots of videos that cover these items. So make sure you keep watching. Subscribe if you can. Give me a like if you enjoyed the video. And we'll see you on the next videos, another episode, to learn more about the home buying process.